But let's move on. Let's focus on Equitas Small Finance Bank. They reported a strong Q4 update. Deposits were up more than 30%. Disbursements as well were up closer around 80% odd. Mr. N Vasudevan, the Managing Director and Chief Executive Officer at the company, joins us on the show. Hi, Mr. Vasudevan. Thanks so much for joining in. Well, a couple of questions. When you joined us in the past, you've said that you'll at least grow by around 25 to around 35% odd. For FY24, what kind of a growth are you looking at? And also, what is the average tenor of your loan book today, if you could compare it with a year back?
Yeah, hi, good morning. See, generally, we are actually still a very small bank. Our advances is just around 28,000 crores. So given this size of the advances, and also the fact that we service segments which are generally significantly underserved by the rest of the banking industry. So on a combination basis, we believe that a 25 to 30% kind of a growth for the near-term future should be sustainable for Equitas. In terms of the average tenor of the loan book that we are having, it's about 2.2 years, and that's more or less remained steady over the last few years. And our deposit average tenor of the deposit is around 1.2 years, whereas on the loan side, it's about 2.2.
Okay, so you said 25 to 30% growth is something that's sustainable, right? Even in FY24. Can you give us a breakup of how the growth in the small business loans are doing and also growth outside of Tamil Nadu?
Yeah, so the small business loans are our flagship program, and that's an area which we have taken a lot of efforts to try and create a lot of niche in that space, and it's not an easy business to do. Our average ticket size, you may be quite surprised to know that our average ticket size for the small business loan segment is just around 5 lakh rupees per borrower. So that's the kind of granular loan that we are giving. And these are people who are purely from the informal economy sector, and which means that it's a lot of high touch and feel kind of business. So that will continue to be our flagship program, and we have built the ability to service that segment quite well over the last about 10, 11 years that we have been at it. And so that should hopefully continue to grow around that 40% plus level. And, recently, about 2 quarters back, we introduced a new variant for that segment, which we call as merchant OD, that is merchant overdraft facility for the small borrowers. Maybe 1-2 lakh rupees of overdraft combined with the 4-5 lakh rupees of term loans. And there's been a big offtake on that also. Obviously, that's a demand which had been so, unmet in the past, that when we offered, the offtake has been very strong. So that segment is something that we will continue to be seriously focusing on.
Okay. Could you give us an indication of what your net interest margins will be going ahead? Because I understand most of your loans are actually fixed loans. So in that context, any guidance on NIMs?
Yes, about 15-17% of our loan book is floating rate, which is largely our home loans as well as our MSE loans, MSE, that micro and small enterprise overdraft loans. These are about 17% of the book, and that is floating rate, which means that the remaining 83% is actually fixed rate loans. And so in a rising interest rate scenario like today, obviously there should be some pressure on the NIM because of 83% nearly being a fixed rate basis. But as I said earlier, our average tenor of the loan is around 2.2 years. So that way the loans do come for repricing fairly fast. It's not like they are a long stuck in the system. Second thing is that our ability to pass on the interest rate on the borrower side is also high because of the fact that we are a preferred banker for the segment of clients that we service. And third is that because of our growth, our operating efficiency is also kicking in. So the cost to advances is something which keeps coming down, and to that extent, that will also cushion the impact on the overall spreads. So what we believe is that our current NIM is around the 9% level. It might go marginally down. But then we expect that should also be supplemented with the similar kind of a benefit in the cost to advances side. So partly we will increase the lending rate on the loan side, and partly our internal efficiency should help us cover up on the spreads.
Down, sir, to about 8.5% or even lower?
Well, it may not go down to 8.5 is what we believe in the near term.
Okay.
In the medium term, it might, but then the medium term, the cost to advances also should hopefully go down.
Sure.
All right. If you could give us some guidance, Mr. Vasudevan, on the asset quality. Gross NPAs, I think you were guiding for, it comes down to around 2.5% or somewhere in that vicinity for FY24. And also credit cost guidance of around 1.5%. Are you holding on to those numbers? You just want to alter them?
So our guidance for FY23 on credit cost was 1.5%. But that is actually slightly elevated to our normal levels. Our normal pre-COVID credit cost used to be in the range of 1.1 to 1.2%. Last year was slightly elevated. We had guided 1.5%, and I think we are broadly going to be in line with that. For the current financial year, FY24, we believe that we should get our credit cost back to our pre-COVID levels, which is closer to the 1.1, 1.2%. And our GNPA pre-COVID always used to be between 2.5 to 2.75. During COVID, it had shot up all the way to 4.6, which was our peak NPA. It was down to 3.36% in December quarter. And, and collections has been very strong in the fourth quarter of last financial year. So we believe that, our NPA should come back to the pre-COVID level very soon.
Okay, NPAs will come back to pre-COVID levels very soon. Can you tell us a little bit more about the restructured book then? How much of the restructured book is expected to go bad in the coming quarters, if you can quantify for us?
So currently, when we restructured last year, it was 9.5% of our advances was under restructured book. And over time, some of them are paid off, some of them are run down, and some of them have become NPA and provided for. Ultimately, what we are now left with is a restructured book, which is in the range of around 2% of the total advances. And out of the 2%, part of that, nearly 45% of that has already moved to NPA, which has got its own provisions covered up. And the remaining 55% of that is in standard assets. And now, these are books which have now crossed over 1.5 years after restructuring. So we believe that further pain from this area should be normal pain like any non-restructured book, because they already crossed 1.5 years of restructuring.
Okay, all right. Mr. Vasudevan, thanks a lot for joining in and all the best for the quarters to come. Let's move on now. The market is actually picking up some more pace.